Greetings, welcome back to our Commercial Mastery series. I'm Kevin Derrick, and this is a module about exit strategies. Now, quite honestly, I did not want to call this session exit strategies because you make your money, as you know, with cash flows at 3 different times in commercial real estate. You've heard this several times, so you can say it with me at the beginning, middle, end: acquisition, operations, disposition. So instead of calling this session exit strategies, what I'd rather do is call it profit centers in commercial real estate. There are so many different ways to generate dollars for you, your family, and your business in commercial real estate. We have to include a session on just some of them, just scratching the surface here on profit centers. But in the few minutes that we have, let me give you a few of them. Get your notebook, get your pen, here we go. Most people look at commercial real estate profit centers, and I'll write that word right here, as opportunities to grow passive income. That may have drawn you to this opportunity with me right now to look at commercial at a mastery level. We would call this simply a profit center to hold real estate. You're basically just creating a number of doors, number of units. We call this portfolio properties or a portfolio asset. Whenever I use the phrase portfolio, I mean it is definitely something that you are going to hold. And quite honestly, from what you've learned so far about commercial real estate, I think you see that this is more than just a viable strategy. I mean, this is how you generate wealth. And ultimately, that's really what we're trying to do. It's not just the fact that we're trying to increase our liquidity or our cash position, but what we're trying to do is to increase our wealth, to increase our net worth. So anytime that you can buy a property at an 11 cap, but you can value it at an 8 cap and it's stabilized and you're moving your NOI up, not only are you making a little bit more cash, but you've created the opportunity, haven't you, to marginalize that cap rate and to create net worth. So if your only strategy as a commercial investor was to find a commercial property, commercial asset, and hold that, and then buy another one to hold that, then that would be a tremendous opportunity for you to create wealth. And so if that's the direction that you want to go, we fully support that. That is a master premise. That is a tremendous, tremendous path to be able to go down. Now, some people look at profit centers as refinance opportunities, as a refi opportunity. I showed you this in the spotter module very quickly, where after we hold a property for a certain amount of time, the lenders will call that seasoning. They want a loan to season. They don't want somebody to come into a commercial property with financing and then 30 days later try to refi the note. They want to see that note season. They want to see the asset stabilize. They want to see your experience level increase and how you're going to actually manage or operate that particular asset. They know what your strategy is. How good are you going to be at running the play? All right. But after a time, after the note seasons, you do have an opportunity to refi. And if you can buy high and refi out at a lower cap rate, that means our value has increased. The lower the cap, the higher the value, and that way you're able to pay off your original note, maybe get rid of your investors, pull out some cash, or leave the cash in, lower the note amount, and increase your cash flow. So some people look at a refi opportunity as a cash out, and I don't mean that you're selling, but I mean it's a cash out refi where you're generating tax-free dollars to put into your business, or you may just continue to hold it with that refi and you have cashed out investors. So you can pull out cash yourself, or you can just cash out your investors. So when we're working with full leverage, the money has to come from somewhere. How long are we going to keep those external pieces in play during the length of our strategy? So if after 24 months, 36 months, 4 or 5 years, if we can cash all of our external pieces out, where the different notes are coming from, and just refi with one entity, then we've simplified that, and it's an opportunity to hold that as a portfolio asset for longer. Okay? Another profit center is to buy and sell. All right. Now, some people would call this flipping. Some people would call it retailing. What we prefer to say is that we are focused on a terminal cap rate. Okay. So in other words, if I can purchase the property at a 10 cap, but I have a terminal cap rate of 8.5, once I reach the place where my NOI is generating the dollars that I need to, and I can move the asset at my terminal cap rate, then I'm going to go ahead and do that and get rid of the opportunity. What we also call this is an opportunity to typically cash out our investors. Now, let me introduce you to a couple of things in private equity. So I'm going to draw a box right here because I just want to emphasize private equity. Many times, when we are trying to do something on a retail side, and by that I don't necessarily mean the space, but I mean it's a buy and sell, many times when we do this, we are leveraging. We're bringing in dollars from outside sources. Could be a corporation that we've started where we've brought in partners, might be an LLC and we've got different managing members, might be a colleague, friend, family member, a doctor, a lawyer, someone we know, someone we don't know. But whoever those entities are, they want to stay in the deal for a certain period of time, and then they want to be out of the deal. All right. Here's how you set those types of situations up. Typically, what we see with these opportunities is that the money is staying in the deal for a period of time from 24, 36, 48 months. So let's say that we have private equity of $100,000 coming into a deal. We have particular terms. Maybe we're paying them what we would call a 10% PR. I'll explain that in just a second. And that's over 36 months. Then we'll give them 50% of DP upon terminal cap rate. All right, let me explain exactly what I mean. So we have this opportunity, much like the sample property that we had in several of our modules, that 20-unit apartment building, average rent $600 a month, and we looked at how we could get in there for $725,000, get a good cap rate. We looked at how we could generate $20,000 a year, even if we were at full leverage. All right. When we talk about that, what is that full leverage? Well, we know that the owner is going to hold a note. At some point, he's going to want his money back. But what about these friends that we brought into the deal? So if I have private equity and they're bringing in $100,000, how do I set that up if I'm going to use the money for longer than 3 months, 6 months, 9 months? This is the way that you do it. We set it up over a 36-month term. And again, this is not specific to every single deal, but just giving you a good foundation and a good idea of the reality of how these things work. What we'll do is we'll set up over a 36-month term, 3 years, to get into the property, and then after 3 years to get out of the property. And we'll give our investors a 10% preferred return. A 10% preferred return. What that means is that in our first year, we may not reach that. We may have come into a distressed asset. We're throwing cash at the property, and so our return that first year may be somewhat minimal. Why? Because that's not what our focus is. Our focus is making money on the back end. So we're looking at the marginal opportunity over the period of time. Remember, acquisition, operations, disposition. In this case, we are looking to make our people money, and we are looking to make money when we sell. So that first year, our return may only be 6%. The second year, the return may only be 9.5%. The third year, when we sell, then we go back to that first year and we give our private equity the balance of what we owe them. That's why we call it a preferred return. Ultimately, they will get their 10% for that first year, but they just may not get that first year, okay? If they get 6% that first year, they may not get that additional 4% until we terminate the project. They're at 9.5 that second year, they may not get that rest until we terminate the project. It's a 10% preferred return. You say, well, would private investors really be interested in doing that? What would motivate them to do that? This will. Because we will also give them 50% of the distributable proceeds upon terminal cap rate, or selling the property, termination of the project. So what we'll give our private investors is a 10% preferred return and a 50% share based on what they brought in of distributable proceeds. So let's say that my company buys that 20-unit property and I bring in one investor that I need, and he's bringing in $100,000. We terminate the project after all expenses and after all fees and all commissions and everything is paid for. We end up with a lump sum. That lump sum is what we call distributable proceeds. Let's say that it's $50,000. What that means is that 50% goes to my investors. So $25,000 goes to the investors. The other $25,000 comes to me. All right, that's how we set it up. And from that $25,000, my investors would get their share. In this case, they're the only ones that brought in the $100,000, so they would get the $25,000. If I had two investors, one at 50 and the other at 50, then they'd split their share of the distributable proceeds. $25,000, they'd each get $12,500. All right, so that's how we set up leverage. That's how we do buy and sell in commercial. That's why the terminal cap rate plays work effectively when folks understand and trust what we are doing. All right, with many of my students, I'll sit down with them on a mentorship and I'll customize an investor profile. It's not long, typically 3 or 4 pages, but it's a document that I customize for them, and it's something that they can use for potential investors for exactly this scenario. I'll also sit down with them. I remember working with a tremendous man, pastor in Seattle, Washington. He said, Kevin, I love this stuff, but I'm not sure how I'm going to present it. I said, Pastor, you preach every single Sunday. He said, no, I know that. I'm comfortable with talking, but I'm really comfortable with knowing what I'm talking about. So you know what we did? We sat down at his dining room table, and he was the potential investor, and I was the manager of the company, and I just did the 45-minute presentation for him. At the end, he said, you know what? I got it. The light's on here, I'm ready to roll, and he's doing fantastic working in Seattle and Tacoma. All right, so that's how the private equity works. Now quickly, there are other opportunities that you have for profit centers. Many of you have heard this term. You can always 1031 exchange. So you buy, you have an opportunity to move it to another investor, and then you have a tax opportunity to have a 1031 exchange, which is simply the IRS code to be able to find like property. Once you sell this asset, you can move the capital to the next asset. You also have the opportunity for owner financing, for an owner-fi situation where, in theory, you have the opportunity to be the bank. Now, stop and think about it for a minute. If the bank loans me $500,000 for a commercial project, why are they doing that? Well, because they trust that I am going to be committed to paying it back, but way more than that, right? they trust that that $500,000 is a solid investment in that real estate and in that business, in that apartment complex. And so they like the price, they like the location, they like the building, and they like the opportunity to make money. Now, what type of money are they going to make? Well, you know what? If I hold that property and I hold it for the full amortization of 300 months or 25 years, that $500,000 will probably turn into about a $700,000 profit for the bank, and that doesn't even include origination fees or any refi fees or re-up fees after 5-10 years, renegotiation fees. So you can see that the reason that banks have really nice buildings that are all brick is because they're doing something right. It's not just the depository relationships where they're making money. They're making their money when they write, when they're underwriting loans, when they write loans, all right? So even on a $500,000, which is small in many cases, a $500,000 loan, they're making hundreds of thousands of dollars. Why do I say that? Because you can be the bank. When you're in a position to do that, then you can make a viable risk decision and you can be the bank and own or FI something. That's why when you really start to analyze the opportunity that you have in this profit center, not only to be the bank on your side, but also to find someone and explain to them, look, if you do owner financing, you're going to make an immense amount of money. Let me show you how. Then there's one last one that I just want to mention quickly, and that is on the retail side, you will often see something called a triple net lease. It's I just use an NNN here for triple net. There's single net, there's double net. What that means, and I want you to just think of an entity that we all are familiar with. When you're driving, ready to go shopping, something like that, you're going to drive by a corner and undoubtedly there's going to be a Walgreens there. Maybe a CVS, maybe a Rite Aid, but Walgreens are everywhere. When you see Walgreens, very typically that building is not owned by Walgreens. Now they'll come in, they'll build it, they'll develop it, but then they'll sell it off to a landlord, either an entrepreneur, a corporation, or an institutional investor. So when you see that Walgreens owns the business, the employees work for Walgreens, but the real estate, the land and the improvements, the building, they're owned by a real estate investor. And that real estate investor has a triple net profit center. What that means is that they don't have to worry about taxes, they don't have to worry about insurance, they don't have to worry about maintenance. Those are all taken care of by Walgreens. Now I know this because I'm on both sides. I'm both a landlord and a retail tenant. And so I understand the triple net leases and all of the different clauses in here. And this is a tremendous profit center. What happens in a strip center is that landlord takes the common area maintenance, those shared fees, they're called CAM charges, and he prorates them for every single tenant. So all of those tenants are paying their share of maintenance, taxes, insurance, and all of those expenses. So as a landlord, it's a tremendous profit center for you. In your cash flow analysis, where you have gross income, vacancy, and then EGI, well, in a triple net scenario, your EGI is your NOI because there are no expenses. And listen, anytime that you're a business owner and an investor and you can get rid of expenses, folks, that is a profit center. Now, take a few minutes, head over to the website. You know I always say this, check out the opportunity to work one-on-one. It's called a mentorship because I actually come alongside of you and we partner, we work together. Check it out, take action today. We'll see you in the next module.